You have equity in the home and you have equity in your life insurance policy. The difference when you die and you have to sell your home, you have to do all those things. But when you die, the life insurance company just writes a check to the beneficiaries. No one has to fight over it. If I die tomorrow, it's allocated exactly where it's going to go. Nobody gets any say. There's not going to be any argument. And we've paid pennies on the dollar for that. Hello, and welcome back to the podcast. Thank you very much for being here. All right. Today, Tarisa and I are going to talk about what is similar between a 30-year mortgage and a life insurance premium. So a lot of people question, oh, hey, this premium is going to last forever. And I don't like that. And people don't like it because they look at it as an expense. Mm-hmm. But your 30-year mortgage is also an expense, right? It's just, yes. Is it different because you get to live in the house and you don't get to live in the policy?
The policy doesn't sound as cozy, like as my own home, but it does give me cozy feelings.
So let's talk about what are the things that are similar and why we should really rethink our thinking on premium versus a mortgage.
Yeah. So I love this concept because it just allows you to think about the big picture. I'm such a big picture person. So people are very happy to sign up for a 30-year mortgage for a number of reasons. I think one of the first reasons, obviously there's variable interest rate mortgages. I personally would never purchase a property that way, but a lot of the mortgage products out there are guaranteed. So it's a fixed rate. It's never, ever going to go up the entire 30 years or however long you have it amortized. So it gives people peace of mind.
Well, let's be clear. The principal and interest isn't going to go up. If you have it escrowed, that can go up, right? Because insurance can go up. So we're just talking principal and interest.
Yes. For those of the people out there that are like, well, what about insurance and taxes? Well, that is a part of your mortgage payment, but we're talking about the mortgage specifically.
All you keyboard warriors, back off. Come on.
Right.
Take a breath before you hit the keyboard.
Yes, let's get into the topic a little bit. You know what I mean? So it's guaranteed. And that gives you a peace of mind because what that does is it hedges against inflation. So, we're in this environment right now where inflation is impacting everything. Our cost of groceries, cost of gas, cost of huda hada yada wada, whatever, right? Cost of mostly everything. So it's like if you can lock in your cost of housing throughout your lifetime, like that's very, very powerful. Mm-hmm. And now, Mary Jo, because of those 2 points that we went over, how is that similar to what we're doing with infinite banking?
So with infinite banking, and I'm going to go back and just clarify too, a 30 or a 15-year mortgage. I don't care what you're doing. 15, 20, 30, it's locked in. Your principal and interest is locked in. With a life insurance premium, a whole life premium, not universal life, because universal life does not qualify for these benefits. But with a whole life premium, it is locked in for the life of that contract. And the way we structure the premium, it even drops down at some point. So year 15, 20, that premium is going to decrease, not increase. So you really have to look at, like, if you want something that's cozy and it's going to be the same all the time, it's the same thing. You're buying that 30-year mortgage because it's fixed and it's going to be the same and nothing's going to go up. Life insurance premium is the exact same way.
Right. It provides so much certainty in your financial future. Mm-hmm. It's like, okay, I know that this is going to be this 20, 30 years down the line. And that makes me feel good because it feels comfortable.
Mm-hmm. Unlike your term insurance, I just talked to somebody and I believe their numbers were, the term was $1,000 a year and then they're turning 65. So it was going to $1,700 a month.
Oh, goodness.
Like, that is crazy. That's absolutely crazy. Because we turned 65. That's uncertainty. You wouldn't want that in your mortgage.
No.
Right?
No, absolutely not. And I think to your point, like this is such a good point that I think people are missing out on. It's like, sure, term insurance is cheaper to a point, and to a certain age.
Correct.
Not forever. It's basically like subsidized, right? It stays level and then you hit 65 and then it's astronomical. And if you added up how much it would cost for them to have coverage for the same amount of time that's guaranteed to you in a whole life insurance policy, it's comparable. And the reason is because there's no deals in the insurance company. So they're going to charge you for the cost of that insurance, except for most people can't afford to pay that term policy when they get to that age. And what happens if you're uninsurable?
Right.
So another reason why people like mortgages and real estate investing is because you gain equity, right? The more you pay down your mortgage, the more, potential gains you have if you do decide to sell a property, or, people offer lines of credit with their homes. That's not something I particularly recommend either, but it is an option. And the same thing happens in a policy. So when you're paying your premium, you have access to a great majority of that cash value, and it is appreciating and gaining equity the entire time you have your policy, which for me is age 121.
Yep. Let's compare those two just for a sec. Inside your home, every time you make an extra payment or you're paying that sucker down faster, you are gaining equity. You have to go to the bank and ask for that equity. You're doing the exact same thing inside the life insurance policy. Every time you make a premium payment, your cash value is increasing. And the difference is you just go online, you fill out a little form, and they ACH the money to your account. As long as you can answer the security questions, which I fail almost every single time. Anyway, so you answer a security question, they ACH the money to your account. You're building equity in a home that you may or may not get to use. Because if you can't make the HELOC payment, or you can't refinance it to get the equity out, you're going to have to sell that home. So it is very similar in the aspect of when you're making a payment, you're building equity on your home. When you're making a premium payment, you are building cash value in your policy. But it is not similar to how we access it. And that is a huge factor. But we're just looking at similarities. But I'm going to point out the obvious.
I think that's good. It's good to look at the entire thing. But to your point, you can access that equity, that cash value inside of your policy very quickly. And the only thing that super matters is like, how much have you paid in your premium, right? It's the same concept as, okay, well, how much of your loan have you paid off and what's the market value of that property, right? So it's very similar. And people love that about real estate. And I think for me, I personally love that about my policies. Like every single day I wake up, my policies have increased. And that's not based off of market performance or what someone tells me my policy is worth, right? It's not dictated or predicated on the market. It's just what have I put in premium, which is exciting. I think for some people, you can look at premium as an expense, but I look at it as my policy is a place to warehouse most of my wealth. And I'm so excited to pay premium. Like if I can pay extra that month or whatever the case may be, I'm so stoked to put that in my policy because I know it's earning for me forever.
I think there's another piece that we're missing here. And that is the piece of you've been a good steward of your home. You've paid your mortgage for 30 years. You die. Your kids have to clean your house out. They have to put it on the market. They have to maybe pay realtor fees if one of them's not a realtor. And you guys can't just agree on what you're going to sell the house for, and you got a big fight over it. Okay. So all of that, then the income comes to the kids. And I do not know, I am not an accountant. I like to play one occasionally, but I am not one. And so does the income from that sale of the house come to the kids taxable? I do believe that it does, because they'd get a step up in basis, but I think that it would be income. Do you know?
I'm not 100% sure on that.
Okay, this is a good question. I'll have to find out. Anyway, we are missing, you have equity in both of these things. You have equity in the home and you have equity in your life insurance policy. The difference when you die and you have to sell your home, you have to do all those things. But when you die, the life insurance company just writes a check to the beneficiaries. No one has to fight over it. If I die tomorrow, it's allocated exactly where it's going to go. Nobody gets any say. There's not going to be any argument. And we've paid pennies on the dollar for that. So we've gotten to use it along the way very easily compared to a mortgage. And when we die, there's some death benefit attached. Income tax free. Estate taxed if you're over the estate limit, which right now is about, I want to say 14.6 or 15.2 or something like that. And so right now we're okay. But that can go up and down. We as infinite banking practitioners sometimes forget that there's death benefit. And I talk about it a lot because estate planning is extremely important to me. But we're building equity. Great, you're building equity in this house. You have to have the bank's permission to use it. But now when you die, you left a home to sell that the realtors get to infinitely make money off of.
And
we provide
too,
them
right?
the job. So it's all good. But something to think about is inside the policy, we also have the death benefit.
I think that's brilliant because I think a lot of people that are oriented to like leaving a legacy to their kids and to their family, they're focused on acquiring assets because they want their family members to not have to start over from scratch. And they want to give them a step up in life, which I think is such a beautiful thing. But to your point, there are definitely more steps that someone has to take. And who knows, maybe they don't want the property. Maybe they want to keep it as a rental. And then how's the rental income divided, right? There's so many question marks once that happens. Like if you're to pass and you have all of these assets to pass down versus with the life insurance, it still works for you like an asset, right? It appreciates. You have access to cash value. You can put money in there your entire lifetime and it will guaranteed grow for you. Mm-hmm. And then when you pass, your family gets that tax, income tax free. That's such a nice thing. It's like, okay, you can get access to one big check or a whole laundry list of to-dos. Mm-hmm. Not to say that it's not worth it, but there are definitely, life insurance is a very uncomplicated thing and a very beautiful thing once that, transition happens and you pass away, to pass things to your family that really make a difference.
Mm-hmm. If you have a elderly parent and they're going into the nursing home, that house is going to have to be sold. And so now it's going to be harder to sell the house. You're going to take a hit on that house. Where in the life insurance policy, if you need to borrow cash value to pay for the nursing home, borrow cash value. Medicaid will ask you to drain or cancel that policy. So I just want to be very clear here that if your parents or you have a life insurance policy and you do not have long-term care, Medicaid will say you need to cancel that policy because it is considered an asset. Cash value is an asset to them. You do not have to cancel the policy. You can take a full loan on that policy. And then they never look at it again. This happened to one of my clients. And so she was smart enough to not cancel her husband's policies because Medicaid will leave you a broke widow or widower. It is absolutely crazy. It's crazy that people don't have preparation for the nursing home and think that Medicaid needs to pay for it, but it's a whole nother topic for me. So if you have a policy, borrow against the cash value, just tell them, okay, I'll just buy it down. Like I'm going to buy down every other one of my assets. But then she was able to continue to pay premium and she got the death benefit minus any cash value loan. So at least she still had enough money to bury him. They were actually super angry with her because she used cash and she went to the funeral home and she bought a funeral policy. Oh, they were pissed. That is not one of the options to buy down your cash for Medicaid to kick in. But they would have literally left her with zero death benefit because all of his death benefit was in whole life. Wow. And he had that before he met me. All of it was in whole life. So if she would have listened and she would have not met me, she would have just canceled their policies because she would have not known the value of that cash value and the death benefit.
That's so interesting.
So with a house, Medicaid says, oh, we can kick in, but if you're the last surviving spouse, you're going to have to get rid of the house because you can't have any assets. So a lot of people will transfer the home into the name of the kids prior, so maybe the kids can have the house. But there's a 5-year look back. So with a home, with a life insurance policy, yes, you might have to use that for the nursing home as well, but you still have a little bit of death benefit because the cash value and the death benefit's not equal unless you're 100 or 121, depending on your policy.
Unless your policy
where your
endows.
home is subject to kind of all of that.
That's interesting. I did not know that. That's such a great tidbit for anyone that's listening.
Understand, like all of these things are benefits. Anything else on that?
I think one thing that we didn't touch on is tax advantages, right? The tax advantage of having a mortgage is you can write off the interest or depreciate the property. And there are tax advantages inside of your policy because that growth happens tax-free unless you MEC your policy. So I think that's such a beautiful thing. There's very few things or buckets in life where you can put money in and you have the tax advantage and tax-free growth.
And in your policy, you can write the interest off on the loan if you're using it as a business expense. So for your house, you get the tax advantage of having the interest deduction. You can also do the same thing with your policy loan if you're using it as a business expense.
And then the tax-free death benefit that we
Correct.
talked about. So there's just a multitude of things. It's like people get excited about the certainty that a mortgage provides them. And I would argue that, your life insurance policy that's properly structured gives you similar benefits that a mortgage does, but like times 3, right? It's like times 3 or more. Well, you get to pay into this thing for, until age 121, which is super exciting.
So to sum this up, we have 6 similarities between a mortgage and life insurance. And those 6 similarities are?
It's guaranteed. It's fixed rate. It hedges against inflation. It doesn't increase like rent typically does or like term would. You can gain equity. It appreciates. And you can take advantage of tax strategy, right? You have tax-free growth in the policy, tax-free death benefit. So it's just an overall great way to look at things as an asset and what they provide you short and long term.
Income tax-free death benefit. I'm just going to clarify because somebody's going to say, well, it's not estate tax-free. The trolls are out there, Tarisa. You're going to meet them all.
I know. Okay. What's up, guys? You need a hug? Everyone needs a hug. I got lots of hugs to give.
Okay. If you want to get a hold of us, it is Mary Jo at Without the Bank or Tarisa Without the Bank. If you have comments, questions, concerns, let us know. If you have a topic you want to cover, let us know. If you've not gotten the books yet, go grab your books, schedule your appointment with either one of us. We're happy to help, and we'll see you next time.